Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and I'm joined today by Angus Gluskie, Managing Director at Whitefield, which is one of the oldest LICs on the Australian market. Angus, great to have you in here.
Thank you.
Right, now we're going to be talking a little bit about the macro backdrop, the big picture, interest rates. First of all, what's the lay of the land from an economic perspective, in your view, and I guess for the consumer on one side and also for the corporates on the other?
Sure. If you read the papers, it would tell you, the headlines would tell you that conditions are dire. We don't think they're quite as dire as that. And in fact, conditions, or general economic conditions, are moderate, at the least they're moderate. So if we look at some of the underlying factors that lead us to that conclusion, employment is very good in an historic sense. Unemployment is particularly low. Australia's got very strong population growth, which is giving impetus to the economy in quite a number of areas. Government spending is strong in some key areas for our economy, such as education, healthcare, and also essential infrastructure. And if we look at our trading partners overseas, many other economies are in reasonably similar situations. So, overall, those conditions suggest that the economy is going okay. But look, against that, we do have to weigh up the fact that costs of living are higher for consumers. And that's certainly where the pain point is currently in the economy. The biggest costs of living, housing costs, rent, mortgage costs are high. We've had costs of living go up in other areas as well. And that we're seeing that in high measured inflation. It's higher now than it has been for several decades. And that is impacting on the consumer. So consumer spending volumes have been going down.
So Angus, markets are currently pricing multiple rate cuts over the next 12 months. You've painted a relatively optimistic picture of the economy. Does that mean you're at odds with the market on rates?
Look, I think it's not impossible that we don't see some rate cuts. The RBA is concerned about the consumer, but I think there are limits to the type of rate cuts that might go through. We do believe that the Reserve Bank's facing a couple of challenges, which it's having to weigh up. So just elaborating on that, if we think about the drivers of inflation that we've got at the moment, they're quite persistent. The house prices continue to be mentioned. And if we think about housing supply and demand, the demand equation is driven in part by population. That's not going to change quickly. The supply, which is the building and construction of new houses, is something that takes years, if not decades, to alter. So while we've got that continued tightness in the housing market, house prices are likely to stay high, which means mortgage costs, rents are also likely to continue to put some pressure on the consumer. So it's that kind of thought that suggests to us there's persistence in this consumer pressure. And it's worth remembering, when there is that pressure on consumers, that translates into wage demands. Wage demands translate into rising prices of goods and services. So I think that's a really tricky dilemma for central banks. I think central bank monetary policy has its best effect when it's dealing with demand-driven inflation. That's not what we've got. We've got a situation of cost push inflation. And unfortunately, that means that if the central bank raises rates, interest rates go up, it puts more pressure on consumers to demand higher wages. That could be inflationary. If they cut rates, that in turn could push up housing prices more, which itself is a source of inflation for consumers. So look, that's a tricky equation for the central bank to balance. It's come about because we've had, I guess, a decade or more than a decade of very low interest rates that pushed house prices up relative to wages. And we now think we've got to go through quite a number of years where we can get wage levels rebalanced to housing prices, so affordability is much better. And I think that achieving that is going to require interest rates to be kept somewhere near where they are.
A good case there. What could upend your view? What's the bear case?
Well, there's no doubt if conditions for the consumer deteriorated more calamitously, central banks will pay attention, and they would have no alternative but to prioritise resuscitating the economy instead of fighting inflation.
you've laid out sort of your base case or your thinking on the outlook. What do you think it means for positioning and where investors can find opportunity? How does that translate to a portfolio level?
Yeah, look, it's one we've given a fair amount of thought to. We believe one of the better ways to position in this situation of slightly sticky inflation is to focus on quality, which you've heard us talk about before. But we feel that companies with strong competitive positions in the industries in which they operate are best positioned to deal with pressures of rising costs and also the ability to pass on cost pressures if they need to. So that's a focus on quality we think is an important element. But interestingly, we're much more cautious about positioning too aggressively around consumer stocks or interest rate sensitives. I think some of the reasoning behind that is that both the interest rate and inflation data tends to ebb and flow. It's quite bouncy. And so stocks in those categories have experienced and we think are likely to continue to bounce around as the data ebbs and flows, which means it's quite a dangerous place to play for investors. And equally, while it's tempting for investors to look at this, the complications for consumers and say, look, let's position away from consumer stocks. But it's worth remembering if central banks cut rates, those consumer stocks will be the first ones to bounce as central banks adjust their policy.
Okay. Could I get you to give me just an example of a company that you think has got one of those defensive style moats or the ability to pass on costs, and maybe give people some context also on one that's particularly sensitive to interest rates, just so they get a feeling for the types of companies you're talking about?
The property trust sector is one that's sensitive or viewed as being sensitive to interest rates. They have a level of borrowings as well as having an asset, holding assets that are typically valued relative to interest rates. So people tend to favour them if they believe interest rates are being cut and get concerned as interest rates rise.
And they've had a good run over the past 12 months.
Well, they were initially sold off on concerns over COVID, so they had been cheap. But yeah, look, they've been coming back as that. I guess people start to look at that propensity for rate cuts to come through.
Yep. And on the quality side, a company that's got that ability to pass through the pass through price increases.
Okay, we've spoken in the past about Brambles being well positioned in the industries in which it operates, so its quality gives it some pricing power. And if I was thinking about other stocks with quite dominant industry positions, you'd think typically of large staple retailers. But look, they would usually be well positioned for that. But right at the moment, they're under a lot of scrutiny around from a regulatory perspective, and maybe this time round they will have less ability to move.
Yeah. All right. Well, ladies and gentlemen, I hope you enjoyed that chat with Angus Gluskie from Whitefield. He's got a view that rates might not come down as much as you think. This is the third in our series of videos. Remember to check out the other two. They're up on YouTube. Thanks very much for watching.